As the things look amazing to retail investors and they are eager to invest in S&P 500 and many tech stocks that are making all-time highs, there is a storm brewing under the surface. To practiced eyes, the markets have started to crumble under the shadows of uncertainty and Chinese housing market crisis. Also, as the crackdown of Chinese government on tech firms has already started to shake the confidence of savvy investors, people still think that the euphoria in the stock market is going to last and the party is never going to end. Even in the non-correlated asset classes like cryptocurrencies, the dog coins have hit the moon and beyond. If you watch this video till the end, it will be an eye-opener and I'm sure that it will help you in making good investment decisions in the future. So first of all, I will provide a brief overview of the current market situation. This will help you in understanding what I think. And after that, we will go through the facts and data to gauge what the best investors in the world are doing to protect their capital from the upcoming chaos. And later, I will tell you my own opinion about the current market situation. And you don't have to even go through individual stocks to observe the overinflated prices. Just look at the S&P 500 index and you will get an idea of where we are heading. Also, if you still have any doubt, let me provide a brief overview of the important clues that I explained in one of my previous videos. I will provide a link to that video at the end. So here is the overview. So after reading the book, The Crash of 1929 by Maury Klein, here are the parallels that I drew between the events leading to 1929 crash and the markets of today. Let me briefly mention them here. Just compare the IPO volumes of today to the new listings in 1929. The new listings on the New York Stock Exchange rose from 58 million shares in 1925 to 102 million shares in 1928. And now look at the current state of the market. The global IPO market continues to boom and the IPO volumes have risen 97% and proceeds rose 99% year to year. And secondly, nowadays the online trading platforms are popping like mushrooms. These platforms make the life easy for the retail investors to invest without any analysis and by tapping the screens of mobile phones. And let us look at the situation in 1929. So between 1928 and 1929 alone, 599 new offices were opened by brokerage houses. So observe closely and understand the dynamics back then and now. So as the events unfold and the positivity in the market reaches levels that were seen in 1929 crash, I don't have a slightest of doubt that we will see a crash of epic proportions to fix the overly optimistic market sentiment. Thirdly, when the prices of companies are overinflated and the people are betting on the companies without doing any analysis, when they think that the growth of companies will be astronomical in future, be scared. This is time to get out of the market. As Warren Buffett stated, I will tell you how to become rich. Close the doors. Be fearful when the others are greedy. Be greedy when others are fearful. And don't just take my word for it. Look at the S&P 500 chart and it will give you a holistic view of the overall market sentiment. And now let's look at the other side of the coin and observe what the savvy investors are doing. So first, let us have a look at what Warren Buffett is doing. So Berkshire Hathaway is currently sitting on a record 149 billion US dollars of cash. That is over the record that was set in 2020. So now we know that he is not buying shares from the market and he is instead buying back the shares of Berkshire Hathaway, meaning his own company. The reason is that he is not able to find good deals in the market, meaning as a value investor, he is unable to find stocks which if he will buy, the value which he will get as a result will be more than what he paid for them. So he is pragmatic. He detaches emotions from his investment decisions and thinks long term. And this is how the savvy investors do it. This simply means that the stocks are overvalued now. Now look at this indicator. The stock market is extremely overvalued and it is currently around 210% of GDP. And even though he has been criticized by some investors that he is having a stockpile of cash and he is not putting the money to work by buying high return assets, he is simply neglecting the noise and remaining true to his investment philosophy. He is not finding good deals. He believes that shares are extremely overpriced and he is therefore not willing to risk his cash by jumping in the market right now. And as you can see in this graph, his cash pile has been increasing steadily over the years. And this is a warning to all the people who think that the prices are going to go even higher. And let me show you another chart which shows that Berkshire has bought 15 billion US dollars worth of its own stocks, and this does not seem to stop. As you can see, the purchases have accelerated tremendously during 2021. So he is investing but not in the market and just buying back the shares of his own company. So the reason for buying their own stocks is to boost his company's balance sheet. And it is not just about the market sentiment. There is another major factor at play here. So the profits of Berkshire Hathaway have gone down in the third quarter. And here is the underlying factor that I was talking about. Berkshire also warned that it did not expect significant increases in aerospace revenues or earnings in the near term at Precision Cast Parts, the metals fabrication company they bought in 2016, due to supply chain disruptions and the continued impact of the pandemic on commercial air travel. And as a result of the supply chain disruptions, here is how the net earnings of Berkshire have been impacted. Berkshire's third quarter net earnings fell 66% to 10.34 billion US dollars, or 6,882 per class A share equivalent, from 30.14 billion or 18,994 a share in the same period a year earlier. Investment gains totaled 3.88 billion in the most recent period a year ago. Berkshire reported gains of 24.77 billion. Now we can clearly see that even though the earnings have gone down drastically, even though he is sitting on a huge pile of cash, he is simply neglecting the noise and focused on one and only one thing, as he has always been, and that is to find good deals and not overpaying for the value that he will get. I wish that most of the retail investors had the same mindset. No, we can't just look at what Warren Buffett is doing and base our viewpoint on that. We must look at other savvy investors and see what they are doing. This helps us in looking at the things from various angles and gives us further clues and signs that will definitely give us the confidence in making our own investing decisions. And it will also help us in gauging the direction where the ship of the market will steer itself in the future. For those of you who are new to this channel, I am Dr. Subail Khan from Subail.com, and on this channel, my endeavor is to help you in making your money work harder, smarter, and in long term. Now let's see what Elon Musk is doing in this situation. So Elon Musk asked his Twitter followers in a tweet, "Much is made lately of unrealized gains being a means of tax avoidance, so I propose selling 10% of my Tesla stock." And most of his followers said yes. So as of June 30, Musk's shareholding in Tesla came to about 170.5 million shares, and selling 10% would be worth 21 billion US dollars based on Friday's close, according to Reuters calculations. Now, just like the majority of people, you might be thinking that he is doing it for the tax reasons, but reality is miles away from it. He was not alone in the boat. Just one day before, I am not surprised to see what his brother Kimball Musk did. So Kimball, a Tesla board member, sold 88,500 Tesla shares on Friday. He sold the stakes at an average price of $1,229.91 US dollars per share via JP Morgan, the filing says. That amounts to about 109 million US dollars. The shares sold represent about 15% of Kimball's equity stake, excluding options. Now we have to understand that the shares were sold at ridiculously high valuation of Tesla, and when the price was at an all-time high. So why is the timing so precise? The reason is pragmatic thinking and detachment of emotions from the investing decisions. And look at the price of Tesla stock. It just keeps on going to the stratosphere, and the thing is that as an investor, you just cannot pay any price for the growth potential of a company. And after the sales of Tesla shares by Elon Musk and Kimball Musk, we can see that the Tesla stock is going down, and some people are understanding what I just said. But let's hope that less people get a dose of falling off the cliff. There is a limit to everything, and people have to think that as the price increases, so does the risk. And jumping in the market and buying the stocks at such high prices is a recipe for disaster. You have to preempt the market and sell when everyone is optimistic. Also, you should buy when the price is not pumped. Also, you must do your analysis so that you don't pay more for the value that you will get as a result of purchasing a stock. It is much harder for the market cap of Tesla to go from 1 trillion to 2 trillion than from 500 billion to 1 trillion, since twice the amount of money needs to enter the market to elevate the price to 2 trillion US dollars. Then to elevate it from 500 billion to 1 trillion US dollars, and in current times it seems highly unlikely. Now, if the information related to Elon Musk and what Warren Buffett is doing was not enough, let's look at one of the most brilliant investing minds of today. I am talking about Chamath Palihapitiya. He has averaged an astonishing 32.9% average yearly return since 2011. So he is at the top of his game. According to him, this is not the time to jump in the market, but he will rather like to hedge himself in this situation. Here is what he said in one of his recent interviews.
Broadly speaking in the market, I'm a little skittish, yeah. Tech stocks in the fucking toilet. Now I'm kind of positioning myself to hedge myself in this situation. I think that most people are under the impression that these are short-term kind of contractions and expansions, and that this is just a thing that needs to get worked through the system as we readjust to a post-COVID world, blah, blah, blah. I think it's different. And the reason I think it's different is if you just look at one thing and one thing only, which is that we have a massive labor shortage in America. And there's an incredible stat that I saw, which was the average hourly earnings of non-manager people in hospitality and travel. And the average salary, the mean salary was around 20 some odd dollars an hour. And it's now $33 an hour. And so what that to me says is that we are going through a really sustained period where you cannot get people to do the work that needs to get done, right? So labor capital, I just think it's getting more and more expensive to get folks to do work. And then there's the raw materials that you use to make anything. And everything that I see is that stuff is going bananas. And so I put these two things together and I'm like, I think this stuff is here to stay. I'm really kind of a little bit of a, and I had not worried. And you can see in every episode before this, I was always consistently like, there is no inflation. You can fade the inflation trade. And now I'm kind of positioning myself to hedge myself in this situation. Europe and the United States, we absorb labor and materials from all around the world, right? We are the net importers. We are the net ultimate buyers of last resort of all of these things. And so if you're seeing inflation in those other, supply-driven economies, they are going to come on shore. They're going to hit us in the face. I think the labor shortage is going to get worse, not better. I think we're going to have to pay people more to get out of it. I think prices are going up. Input costs are going up. Energy costs are going up. So this is it. And I think that we are in a period that will resemble the late 70s.
So it means that Chamath has the same opinion as mine and thinks about the current state of the market in the same way as Elon Musk and Warren Buffett. So here is the conclusion which I can draw from this discussion. The market is showing all signs of euphoria. It is not the right time to invest, but time to wait for the correction, and this is evident from the recent steps taken by Elon Musk, Warren Buffett and Chamath Palihapitiya. The prices are way too high currently to justify the value that we will get by buying most of the stocks. Please let me know in the comments below, what do you think about the current state in which the market is? Also, are you accumulating the stocks now? If yes, let me know which stocks are you buying currently. Hope that this video has given you value. If you like the content of this video, please subscribe, press the bell and select the option all so that you can get the notifications of the future videos in time. Have a wonderful day and I will see you in the next video. Bye.